I've been asked fairly specifically to talk about exits and how to exit. So let me give you a few concepts first, and then I want to look at some specific stocks and how we've reacted and so on and so forth. The first thing is if you are looking for somewhere to exit, first thing is to look at a bit of historical data and see if there's a point where there is a gap in the chart. For instance sake, there's a gap here on the Commonwealth at about 74.60. So if you had a buy signal, if you were long Commonwealth, you could wait for, or you could profit target that gap at about 74, 75, yeah, $74.75. Now there is another gap up here, so you might aim for that, which is about $79.50. But for mine, you wouldn't be buying this until it broke that $75 level. Then you might target that $79.50. But point being, very easy to set profit targets and exit upon the filling of a gap. Next concept, in a bull market, which we don't have yet, we've got a pretty good market in one sector. On higher priced stocks, you could use as an exit 34, 55 day dual moving average crossover. I've seen that crossover just perform so well in a bull market. Now, as far as I'm concerned, we won't have a bull market until we've broken through the 07 high at about 6860, and probably a few months after that. Once we're through the 7,000 level, I think we'll have a pretty strong to a bull market at that point in time, whenever it happens. Another concept, I've always said, in any stock priced greater than $2, if in any 5 consecutive day period you have a 20% increase in price, just take it, or at least sell half. As an example, we had a lot of our portfolios involved in Santos. We bought roughly $5, and when the takeover was announced on this day over here, market opened at 620. Sorry, the open was 620. No, it wasn't. That was today. The open on that day was 610, and the market went to 620, which gave us a clear 20% profit in one day, let alone 5. So as soon as we woke up to that and saw the news of a takeover, we started selling. We sold 50% of our position. We still hold the rest. It's starting to look like that takeover will go ahead. But anyway, there's my 20% 5-day rule on stocks over $2. The next concept, always use a stop. And the other concept is to, once you enter a stock, look at the most recent obvious low and place your stop there. So for instance sake, let's just assume or pretend that we've bought a break of 518 here somehow, over here. Let's pretend the market didn't gap up. We buy a break of 518. On the day that it breaks, I'd have my stop under this point here, about 478. Now that we're up there, I could move my stop here, but I'd probably have it a whole lot closer. So a data point is going to work better for you than a percentage or a dollar value. Now, getting into some specifics, KRC. Now, we bought this. We were fairly heavily into it back in here. We bought 4.7, 4.8 and a touch on a break of the 5-cent level. At that time, our stops were under here at 3.7. We went in fairly heavily, I guess you'd say, 200, 250,000 of them, 500,000, depending on the account size. And I always knew the market was going to stop at 10 cents. So we sold a lot at 9.6 and 9.7. Of course, it didn't stop at 10 cents. It went straight through and up to 19 cents. So we had a choice. Having sold 9.6, we intended getting back on a break of 10, but didn't. So we could either sit there and curse and kick ourselves for the next 2 weeks until it got to 19. We could have chased it. We could have done all sorts of things, but we simply sat aside and watched it go. We had taken some very nice profits, so let's be happy at that point. And lo and behold, 2 days ago, we were back at about 7.3. So we could have easily got back in lower, far lower than our sell point. But again, we haven't got a buy signal. So I'm just looking at this level across here at 10 cents. That might be the next buy signal. If that happened on Monday, we'd have stops under this data point. So always a data point. Why did we take profits on KRC? We had no sell signal. We had nothing. It was just the 10-cent level was approaching. We had some very tidy profits and we weren't going to give them back. Now, IMC, this was a saucer. Now, one of the nice things about trading patterns is that you always have a profit target based on the depth of the pattern. So let's look at the high here, say it's 30. Let's look at a low and say it's 14. There's 16 cents depth in there. So from where it breaks at 30, add 16, this should go to 46. It actually went to 60. But I don't think you'd be disappointed if you got out at 46, given that it happened in about 2 weeks. A similar situation is or was LYC. If we go to a 5-year chart on LYC, we have a low down here on LYC of 32 cents. The top of our saucer here is $1.42. So the depth of the pattern is $1.10. If we take our breakout as $1.42, add $1.10, this should go to $2.52. We're now at $2.76 and still going. So trading patterns gives you a target. Now, let's just assume that we had traded the saucer on LYC. We get to the target of about 252. Then let's just say you chose to sell half your parcel at 252 and you're sitting with the rest. Time moves on and we break the 250. We start going sideways. We look at this pattern. We now have an ascending triangle. So on the break of the ascending triangle, you might choose to buy back the half that you sold at 252. If you sold them all at 252, you just might buy a small parcel on a break here of the ascending triangle. But whether you're holding none or half or adding to a position or whatever, if we blow that up, I think your stop should go under this most recent, most significant low data point, about $2.33. And the idea is to trail your stop and let the market take you out. Clearly, that's the best way to exit. Rather than you having to make a decision on when to get out, let the market tell you. Unfortunately, that sounds a fair bit easier than it actually is. Talking about gaps and targets and tiddlers and exiting, this stock RAN Range International, only 152 million out there, not many traded. In fact, it's very thin. But this stock, if I just back up for a second to SCU, if we go back to an original bit of data back here, we've come down a bit, we've gone sideways a bit, we're boxed here. If I really zoom in to that, I don't think it is vastly different from what we're now looking at RAN. The thing with RAN, depending on how many you buy, you know, if you're going to buy 50,000 of them and spend $3,000, well, I'd probably, you know, think about getting out in the high nines, which is still going to give you about 30% return. If you're going to hit it with decent volume, first thing is your stock could comfortably be under here at about 5.3. I'd suggest you're going to buy a break of about 7.3, and if you hit it with decent volume, you might sell half of them at 9.7, 9.8, 9.9. But here's a possible profit target up here at about 18 cents, i.e. closing the gap. So stops are, in general, the hardest part of trading. A very old futures market trick is once you have entered the market and you place a stop below the most recent significant low point, just raise your stop by 1 tick per day. So if you've got a stop on RAN at 5.3, on Monday you make it 5.4, the next day 5.5, then 5.6, 5.7, and just keep chasing it by a tick per day until you knock yourself out. So with that pun, walk forth and knock yourself out. Have a great weekend. I'll talk to you next week. Cheers.